All right. Well, 3:30, right on the dot. Good afternoon. It's good to see you, John. Love your
Hey,
background.
Oscar, how are you?
Good, good. All right, 3:30 in the afternoon. Welcome everyone to the KoreSummit Webinar Series 2021. My name is Oscar Joffrey. We're really excited once again to have our great panel discussion. Obviously, everything's about the topic at hand. We'll get to that. Just to tell everybody, the format is very simple. The format is basically the two speakers. We're going to have a discussion, discuss it, grind it out, agree, disagree. And of course, afterwards, well, during the session, there's a little hand there. Raise your hand. You can ask your questions. And our speakers, both Mark Roderick and John Hong, will be able to answer your questions. Very, very straightforward as well. All our webinars are available to you at KoreSummit.io. You can watch them at any time, share them. And of course, we still have about, I think 70 are, yeah, maybe, no, 65 more webinars are still coming in the next little while. So we're bringing you a lot of education. So welcome again. And we're pretty excited to have you here. Mark, did you make your way in? Okay, so Mark Roderick is, he is there. He's gonna make his way in. He's probably having some technical difficulties as some people may be having with Zoom today. So, but the show must go on. And when he comes in, we'll do the introduction. So as with every one of our sessions that we have, we want you to hear from the speakers, learn about who they are, and then we get into the discussion, the educational element. So John, it's on you, my friend. It's all you. Please introduce yourself.
Sure. My name is John Hong. I'm with Sutter Securities, and we're a retail investment bank based out in Irvine, California. And we have a few different affiliated banks with Bowser Securities and Sutter Securities, Inc. And we operate a funding portal called flashfunders.com, which we also run through our Reg D and Reg A plus and IPO offerings as well.
Great, thank you. And obviously, we hopefully will get Mark to come on board here. He may be.
Can you hear me now, Oscar?
Yes, sir. I can hear you now.
There we are. I'm sorry.
Okay,
yep,
but
just
what
that
about
old Zoom. Yeah.
The bug is back.
The bug is back. Yeah.
All right, Mark. Introductions. Too bad nobody can see you, but you're there. Please.
Yeah, my camera's not working. It's probably better for your audience that way. Yes. So you want me to introduce you, Oscar, or just myself? No,
just you, my friend.
My name is Mark Roderick, and I am a crowdfunding lawyer. I've been a lawyer. I started practicing in 1840, as I always say, and I've always represented entrepreneurs and their businesses. And when I saw the Jobs Act on the horizon, I realized that it was going to be super exciting and disruptive and transformative because the capital formation industry, as we all know, needs disruption. So that's what I've been doing ever since. So I represent portals, I represent issuers, I represent every kind of player in the crowdfunding industry.
Perfect. Thank you for that. And if you don't know Mark, just go to LinkedIn. He does a lot of writing supporting I always see him as one of those lawyers that's there to support the little guy and obviously to make sure they become big. But he's been a very strong voice for advocacy for Regulation CF. He's a big advocate for it. And we finally got our wish. So I'm going to start with this. For those that are on this call that haven't heard the news, it is official. Yes, you will be able to raise up to $5 million US using Regulation CF. It was kind of a nail biter there until January the 29th, 11:38 a.m. Eastern Standard Time, when it was official that we were moving forward. There was a bit of a kind of a hiccup. We almost thought it didn't, but here we are. So what does it mean? It means that we need to change the way we're moving forward. It means that the options are here. And today we got two great speakers that are gonna, help you through that journey, because it's important. That's why we're having all these educational elements, because the more people you speak to, you're getting them all in one shot. You're hearing from Flash Funders, which is a RegCF, but also operated by a broker dealer and a leading lawyer in the discussion. And of course, today, what are the RegCF options to raise the capital? So I'm going to start with Mark, because Mark, you and I have been in many webinars outside of the industry, more in the financial side. When people think of RegCF, they have this connotation that, oh yeah, it's not crowdfunding stuff where you give away money, you get a product, and it's really not like that. So tell everybody what RegCF is from your point of view, because I like the way you tell it.
Okay, well, so, I mean, the first thing that I will say, for anyone who doesn't already know, is that RegCF is not Kickstarter. So Kickstarter and Indiegogo are what we call donation-based crowdfunding, where you give money to a worthy cause and you get a baseball cap or a CD or something like that. You're not making an investment. That is not what we're talking about today. RegCF is an investment. It's an exemption, yet another exemption from the Securities Act. The law that created all this, the Jobs Act back in 2012, created crowdfunding, and it created three different kinds of crowdfunding, what we call Title II, Title III, and Title IV. And RegCF is titled the same thing as Title III crowdfunding. And it is really revolutionary in terms of the history of American securities laws, in the sense that it allows an issuer to freely advertise an offering to every investor in the world without a pre-qualification consent from the Securities and Exchange Commission, right? So, I mean, you can advertise, anyone can advertise. All you have to do is spend $1 million to do an IPO, meaning an initial public offering, like Facebook or Uber or Airbnb. You go through a whole SEC process. The SEC reviews all your submissions, super long, super expensive, and now you're a public company, and then you can advertise. And that's how it's always been for the last 85 years. But for the first time ever, RegCF allows you to advertise to everyone and accept investments from everyone, accredited and non-accredited, with no prior approval from the SEC, and really with very little friction and very little cost. So it's a huge, huge deal, which will become a much huger deal if the rules change. But the first thing I always want to say in presentations like this, where everyone may be new to the field, is all of crowdfunding, Title II, Title III, and Title IV, while encumbered by lots of legal rules, the one thing, crowdfunding is just the internet. It's just the internet coming to another industry, in this case, the capital formation industry. And when you think about what the internet does in every industry, is it connects buyers and sellers directly and bypasses all the middlemen who have historically taken a piece of the action. So that's what crowdfunding does. The internet, it allows the entrepreneur to connect directly to the investor without Wall Street, without all those middlemen. And in that, if you think of it in that way, particularly younger people who are used to using the internet for everything in their lives, it all makes sense. That's why it's growing so quickly. That's why it's so successful. And that's why it's going to become even more successful. It's just the internet coming to the capital formation industry. So that's my summary.
Yeah, I remember you mentioned it. I always like that component from especially coming from a lawyer, which is very positive to hear. John, obviously, from Flash Funders, you guys must be excited. This new option now that it's increased to $5 million. Where do you see that, obviously going from what Mark was saying? This is the internet bringing it, the capital markets to something that's already there. How do you see RegCF working out in this environment?
Well, I'm really excited about it. One, because the way the rules existed before just wasn't very sensitive to what early stage companies were looking for, just the burden, the cost, and kind of navigating even the Form C. I mean, you had a lot of upfront capital to really get a RegCF launched, and then you were capped at raising a maximum of $1 million in a 12-month period. So those limitations are now removed. I think $5 million that's real money. That's money that can really get a good early stage company to the next stage. So as a platform, we kind of use Flash Funders for a variety of capital raises, CF being one. We actually closed the very first CF. It's called for Mobile Strike, not for a lot of money, but it was the very first one. But we primarily use it for our deal execution for our broker dealers, Reg D and Reg A Plus and IPO offerings. It was just because the CF rules made it very difficult for companies to raise capital. And I definitely appreciate the SEC kind of revisiting those, of course, with a lot of feedback from the industry and kind of expanding and increasing the limits, and even increasing the individual investor limits, which is going to be a significant boost to the exemption. So, I mean, as a portal and as a company, we're very excited. We have a lot of already companies approaching us, interested in doing RegCF. Many of them, are looking for a white label version of software, which we can also provide. So we are very optimistic with the outlook.
You brought up an interesting point there. I think it's one that we often don't talk about. What we do, we touch on it just like now, but I'm gonna horn in on it, because we talked about the opportunity that's been given. This regulation CF is giving this new option to raise up to $5 million. Is going to bring a new type of company. It's exciting for companies now to raise even more. But I know, Mark, I'm going to go to you on this one, because you're always the champion as well for the investor. This new update amendment is changing the type of investors that can invest and the investor limits, if you can touch on that, because that's a great story as well.
Right. So let me start, which is with the point that I think that matters most and where I always want to focus on. So the crowdfunding industry, the people in the industry, almost by definition, all the portals, for example, and really all the lawyers and everyone else, focuses on the industry through the end of a telescope that sees things from the perspective of issuers, entrepreneurs trying to raise money. And, that landscape looks terrific. Crowdfunding is bringing capital to more places geographically, to more kinds of entrepreneurs, minority entrepreneurs, female entrepreneurs. So it's doing a terrific job expanding access to capital for entrepreneurs. The other side of the telescope, which I really encourage everyone in the industry to look through, is what the landscape looks like from the perspective of investors, because that's the other half of the equation. The crowdfunding ecosystem can't work for issuers and portals unless it works for investors. And from my perspective, so I am about, and most people in the industry are about, the democratization of capital. That's an expression you hear frequently. And yes, half of that means getting capital in the hands of American entrepreneurs wherever they live and whatever their socioeconomic backgrounds. However, just as important is making high quality investments available to ordinary American investors, right? We have this terrible problem with wealth and income inequality in this country, where historically the best deals are reserved for people who already have the most money. And crowdfunding offers an opportunity to change that. And it is changing it. It's making institutional quality deals available to retail investors. So, you know, that, in my view, is where the industry should focus its attention. And if you make investors happy, if you offer them good deals, you know, that's what is ultimately going to ensure the health of this industry. So that's my little take on that.
That's a great point. That's a great
agree.
point, Mark. Yeah, I think we're at the stage now. I mean, look, the stats came out. 358,000 investors put money in 2020. I mean, that's not a small number. I remember the first year, it's a huge number, and we should be all applauding everybody. But the work just begins. And I think sometimes for entrepreneurs, you've been given this wonderful gift. I'm just going to recap the Jobs Act. I do this in every webinar because it's important that people understand what the creators wanted, what the father of their Jobs Act, people like Mark and Sarah, Douglas Elanoff, you know, Louis Veloquat, Marty Tate, many, Robin Sosno, all these lawyers that stood up when everybody else was busy doing their thing. They took time out of their day. They didn't get paid for this. The only recognition. But the Jobs Act was one, democratization of capital. We've done that. The rules are there to do that. Number two, to give you back the ownership of your company. So you got a responsibility now. You get to call the shots. You don't have to go the other route, or you can blend it in. But that responsibility is what Mark is talking about. You can't take advantage of these retail investors. They're the greatest gift we've been provided, and we need to nurture that properly. And obviously, great comment for you, John. I'd love to hear your feedback, because for Flash Funders' success really relies on making sure those holders are well taken care of and maintained going forward.
No, yeah, agreed. I mean, the last thing you want to do as a funding portal, and when you're kind of on the forefront of the CF, you know, the Jobs Act was provided with title with regular CF, is you don't want to, you know, put up just bad companies that potentially could have long-term repercussions for your own reputation, and of course that are not great custodians of an investor's money. But what I like about the expansion, the increase of the investment, or the increase to 5 million, is now maybe higher quality companies would be more interested. Before that, when they're capped at 1 million, that automatically limits the types of companies to very early stage companies, pretty much seed stage companies, which obviously come with high risk, potentially high reward. But if we start kind of exploring the space where companies looking for a Series A at 5 million, now you got companies with a bit more traction, potentially even some revenue. And you can, it's easier to define and categorize like a better company that kind of fits that model.
Yes, I do agree with that. We are going to see, with a $5 million increase, we're going to see a very different type of company coming in. We're going to see them come in and you want to use the exemption, and they're going to be new to this type of shareholder as well. This is I would say at the moment, the existing 358,000 well-groomed. So as well-groomed as possible, meaning that they're accustomed to certain things. They're accustomed to how a company is transparent. And I know people, what are you talking about? Well, the new era is about sharing, not keeping it to yourself, meaning you share the news and the journey of your company, and those who do it right are rewarded so immensely by this crowd that when you do your next round, they're the first ones there to take up more of your equity, because they see the value that you've done. You've delivered, you met all your milestones, and the reason you did that is because they were seeing it all the way through. So, you know, the options of raising capital have been limited, as John alluded to, because of the $1 million And traditionally companies would go, okay, I do $1 million. Yes, I can blend it in with a Reg D to do it side by side, or I'll go to an angel group or venture capital. You know, I read in our report recently from PitchBook. By the way, for all of you, that's you know, it's a industry leading research for private companies. And what people don't realize though, it only represents 1.8% of the overall market. It does reports on 1.8%. Let's call it 2% for the grading. That's all it provides reporting on. And all of us, we look up to that, right? So when crowdfunding first came out, when the jobs came out, they had it in their newsletter, like one line item. This thing is to help, you know, Kickstarter companies. I'll never forget that. That's going way back some years. But now, they recently published something that really woke, I believe it's waking everybody up and saying, this thing has got legs, it's got momentum. David Weil, I like his words. He goes, this thing has got momentum moving forward year by year. This thing is doubling and tripling and quadrupling and now we got a great catalyst of COVID-19 that you spark it in there. And when PitchBook came out with their report saying that crowdfunding regulation CF will now have an impact on a Series A. And this is quite significant because money now needs to compete for you, not the other way around. You can be one of the 2,000 companies that the entire industry invests in that year, but more importantly, you have options. And that's, I think that's the greater, the same responsibility that you would have to your shareholders, VC, private equity, and all that. It's the same that you would have to the smaller investor. Just because they put in a smaller amount doesn't change the dynamics. Mark, obviously, you and I have talked about this before in other webinar. We've discussed the component of, because of these options, the entrepreneur has a different way of guiding. How are you guiding companies that are actually blended with these two environments? They may have some private equity. How are they adjusting to this new option that's in front of them?
Well, I think the answer is most companies are just astounded to learn that crowdfunding is possible. You know, the act was signed into law by President Obama almost 9 years ago, but it's amazing how many people are not aware of it. And you know, because of my blog, and I'm well known, you type me into, you know, crowdfunding lawyer into Google and you get me. So I field tons of calls and emails from all over the world. And I can't tell you how many people, even now, you know, we talk about it, I answer some questions, and they say, and they're not quite believing. You mean that, you know, I can raise money from anybody? What? No, that can't be. You know, I've been doing this 25 years, Mark. You can't do that. And so the first thing is that they're shocked that they can do this, which is great. You know, I get to be the bearer of good news frequently. You know, this question always comes up, Oscar, that you and I have talked about at length, that I've written about at length on my blog. You talk about the interplay with private equity and so forth. The question, people say, well, if I raise money through crowdfunding, will I then be able to raise, you know, a Series A round, or, you know, raise money from VCs or a private equity fund? And you and I both know the answer is absolutely yes. There's, you know, no problem at all. But there you see some reluctance, or it takes some convincing, I guess, which is just telling people the truth, that you can have it all. You know, you can have money from the retail crowd, you can have money from VCs and angels and everything in between, and there's no problem at all with that. I mean, one of the really great things we've been seeing recently as we look forward to these new rules is the quality of the companies that are expressing interest in Title III raises and following through with Title III raises. In my anecdotal experience, and John would know more, but the quality of the company is just increasing dramatically. just in the last month, I've represented a couple companies that have already had Series A rounds and are very, very successful revenue, a lot of revenue generating companies that are worth a lot of money, and they have looked to Title III crowdfunding. So with those kinds of companies, you are definitely, you're planning for the next raise. You're saying, well, what should we do and what shouldn't we do in this crowdfunding raise in anticipation of our next raise, whether it's, to accredited investors only or Regulation A or a public filing. So that is definitely part of the conversation now as the industry matures.
I agree with you. And I'm going to share personally, I think that we crossed something really interesting. I'm very excited that we were able to attract VCs knowingly, and we were candid. I mean, there were some VCs that walked out of our offering. They said, no, if you're going to do crowdfunding, we're out. But the ones that stayed, they know now that they can be doing it side by side. They don't fear it anymore because now they understand the value behind it. And we're going to talk a little bit about that as well. But so I agree with Mark 100%. You cannot do the entire, as the amount gets bigger, you're going to realize you're going to need private equity, institutional, and so start that conversation. They may say, hey, they may say no at first, but if you got some traction going on, you've got $1 million, $2 million, they may want to come in and, even if it's a token investment of $200,000, you got them in. You know what I mean? It's part of your offering. And I think that's the exciting thing. They're not all going to go for it because they may want different things. John, I mean, how are you seeing that at Flush Funders? Are you seeing that kind of mix right now? Are you going to anticipate that springing on now that it's been increased to 5 million?
Yeah, so like Mark was saying, a lot of the companies we speak to, they've heard of RegCF, but they don't know the specifics, right? They don't understand that they can do general solicitation and market their offering to the retail public. And they're pretty surprised by that. I mean, they're always under the impression that there are some limitations. They're familiar with an IPO, and that only if retail investors want to purchase stock in the company, it has to be a publicly listed and registered company with the SEC. With that being said, I really believe that the types of companies that we've been approached by now, a lot of the ones that we deal with doing strict Reg D are looking for about $5 million. They will do like a bridge round or a $5 million note. Now that CF is available, they're very interested in potentially exploring that. It's a matter of kind of explaining to them the rules and how to help them navigate the space so they better understand the kind of, there are some burdens with doing a CF raise versus doing a straight Reg D raise, right? There's some filing requirements, and of course, there's some upfront capital that needs to be spent on preparation of the docs, which versus going online and pulling a set of Series C docs from some website and then going about and raising your capital. But in light of everything, I think this is a very positive development. The restrictions that are in place with the current rules, I believe they should be there for investor protection. There's definitely those that would choose and could abuse the rules. And hopefully that isn't the case. But, in the beginning, we're slowly rolling this out. And as we kind of were many, many years into this now, I like what the SEC has done and kind of not so much open the floodgates, but crack them open a little bit and kind of let the industry kind of evolve with the new rules.
Yeah, I share I think we all share the same comment to everybody. As much as we're all excited on one side, we have still a long journey to go ahead to educate the market. And that because of that, it will give more options to companies because there's nothing more frightening. And I have been on a call with somebody in Houston, Texas, where the accountant, a certified accountant auditor is saying, you're giving my client false advice. And I say, I'm not advising them, I'm just making them aware. I'm sure if there was a regulation that they can raise money from the general public, I would have known about it. I said, don't take my word for it. I'll give you the link from the SEC. There is no way the SEC would have ever done that. It is amazing, to Mark's point, that we made some great inroads, 358,000. So even though the options are available for companies, we need to be aware that we still have a lot of education, hence the reasons for these webinars, because I think it's important for everybody to understand the options are available there and companies need to go through these elements. And obviously one of them is the legal counsel. But here's the other part, and it's an important one. You should never, ever undertake any capital raising without talking to your lawyer, or a lawyer that knows the regulation rather than one that is trying to figure it out. You'll soon discover the differences. But the one area about RegCF now that is different, I believe, is going to be how you can do it. And so I want to touch on, there's two different new dynamics in that. So I'll start with you, John. I mean, obviously RegCF traditionally, you can raise it on a funding portal. I mean, that's been the restriction to date. And you know, that's where people go to flash funders in the world. So now we have a different option available to them. Are you familiar with that?
Yeah, somewhat. Love to hear your explanation on it.
Sure. So obviously, you know, when the regulation for, well, Mark, I mean, are you aware that there's different choices? I mean, you may or may not, but I thought, why don't I throw it back at you?
What's your question?
The question is,
yeah.
as a client,
what are you asking?
So company ABC comes to you, Mark, I want to raise $5 million. You go, great. So my option is to go to a funding portal, but do I have other options in raising my capital?
Well, you could be asking me about something very subtle, and I'm not sure that's what you're asking me. But
no problem.
I will see about that in a second. But so companies do call me. That's what they call me and say, I want to raise capital, and how can I do it? And so there are several options. One, if you have a rich uncle, get it from him, or yeah, I guess it has to be him if it's an uncle, but I don't mean to be sexist. If you have a rich aunt, get it from her. So I mean, they're normal sort of traditional fundraising routes, but if which is true of most people, you don't run in wealthy circles and you don't have buddies who can just write you checks, then you think about the crowd. And there are different, for the person you're talking about, the choices are either Title II crowdfunding, Title III crowdfunding, or both of them together. And Title II crowdfunding, just very briefly, is sort of wild, wild west, no legal rules, except you can only raise money from accredited investors. And that is, I mean, as I tell people, and they're shocked to hear, you can have a business, put up a website this afternoon and you can start raising money from it, and that'll be perfectly legal. So that is one option for that person. Just put up your own website and start raising money from accredited investors only. Another related option is to use Rule 506C, Title II crowdfunding, accredited investors only, but use a portal. There are Title II portals out there in various industries, and they have a lot of investors signed up. So, you might find it easier to raise money from accredited investors from a portal. And then, the downside is you're going to have to pay that portal for the privilege. And so we then talk about it and we say, do you think you'd like to raise money from non-accredited investors? What's your company about? Do you have a lot of customers who might be investors? And that whole conversation. And of course, I'm making this as brief as possible. I hope, that can be a fairly long conversation. But sometimes we end up with, we would like to or need to raise money, not just from accredited investors, but also from ordinary people, non-accredited investors. And in that case, there are options. A traditional Rule 506B offering, if you know some non-accredited investors or a combination of accredited and non-accredited, You can do a Rule 506B offering. You can't advertise it on the internet, but you can do it to people you know, and you can include up to 35 non-accredited investors. So that's yet another cubbyhole that you can fit into possibly. But if that doesn't work, no, I don't know anyone. I'd like to be able to raise money from non-accredited investors. And so then we end up at Title III. And when you're raising money under Title III, as you know, you are required to use a funding portal, like John's, and they are registered with the SEC. They are members of FINRA, which is a somewhat arduous process, but you are required to go through a funding portal. Once there, many funding portals, I bet John's included, will suggest, depending on how much money you're trying to raise, a simultaneous offering under both Title III and Title II, and that is allowed too. So that's yet another flavor. Now, the very subtle question, and I'm not even sure you were asking me this question, is some portals have, and I don't know whether John's has or not, have begun to play with the idea of licensing their portal to individual issuers. And so let's say Mark Roderick wants to raise money for his company. Some portals are, again, sort of toying, at least, with the idea of allowing Mark Roderick to run that offering at his own website using the portal's software. And that is a very subtle thing. I don't think anyone really knows if it works, and it's what the parameters are. And that's why I'm not sure you were asking me that question.
No, but I think it was a great. That's a great answer. That was a great
Mark,
answer.
So what is your take on that?
I knew you were going to ask me that.
Right. Like with any kind of Form C filing, you have to have a designated funding portal. But if you're operating on your own website, are you kind of circumventing the rules, or is,
that's
let's say,
question.
Is Flash Funder to say still the name funding portal, but it's just, see, that's the confusing part that hasn't been really explained.
And I and probably a handful of other lawyers have calls into FINRA to ask them exactly this question. So here's what would be an example of something that would be perfectly legal. Mark Roderick's business just has a link at its crowdfunding or at its regular business website. We're raising money, click here. And the click here takes you to John's funding portal. And, everyone goes through the whole process at John's funding portal. That's perfectly legal. Next step, kind of down what if people can't see my offering at John's funding portal? What if the only place they can see it is at Mark Roderick's website? And what if when they click on Mark Roderick's website, the only offering they see is Mark's? They don't see any of the other offerings that John's funding portal is hosting. And when they click Invest Now, and it's all branded with Mark Roderick's company. They don't even see the name of John's funding portal anywhere. That, I think, is at the other extreme. That doesn't work. But there are, as anyone, you guys and all the listeners can imagine, there are lots of possible permutations in between those extremes. Mm-hmm. And there is a lot of thought in the industry being given right now, pending an SEC clarification on, where in the spectrum it stops being okay. And again, Oscar, I'm sorry if I introduced, I don't know if that's what you were asking me, but.
No, it came close. You came close, but you came close to it. But the two new that we didn't have when RegCF was first introduced was the broker-dealer. The broker-dealer dismissed the regulation completely, right? You remember that. they would go, oh, this is kiddie, Kickstarter stuff. We don't want to have anything to do with it. This time they're back. They're now saying, wait a minute, 5 million, that's my sweet spot. You know what I mean? So a lot of RegCF broker dealers are getting registered for RegCF. Now, why is this different? Because a broker dealer is going to provide, and we already have a few clients doing this, they're going to provide a dedicated page to that issuer. So there is something new that is arising. We'll have different types of issuers. We'll have them different stages, startup, operational, and then one that's a little bit more established. Not everybody wants to be in a crowded room. I want my offering to be by myself. If I'm going to spend that kind of money, I want that traffic to me, nobody else. And I think you touched on that, Mark. So these offerings are being done on a URL that the broker dealer controls. So that is already allowed within FINRA, but there is a broker dealer in this opportunity, and the broker dealer working alongside the issuer. So that's what's different that we didn't have before. And the dedicated page is the other. So we've seen broker dealers like Sutter who became a funding portal because that was the only option. It makes sense, to limit.
To correct that. So a broker dealer could always operate and do regular CF offerings. It's just because BD's generally avoided it because of the heavy compliance component with it. A lot more work on the BD side than funding portal. So the first CF offering we actually closed that under our broker dealer because our funding portal application was still pending.
Yes, but a lot of them, just like Reg A, you still got to make the application to be allowed. So that we do know. I mean, making the request, becoming a funding portal is a totally different thing. But the point is, BDs are now coming in. So we now have, I think the latest count is, 68 or maybe more funding portals. Prior to the new amendment, there were 51. So you can see more are being added. And now there are broker dealers who can then provide you a dedicated page. So again, you're getting options on raising capital. You're getting options on how to raise your capital. I mean, Mark, you and I have been advocates about this. Choices. Not one, you got to, the only model is this, that's it. No, you don't need to. The model is what works best for you with the journey of your capital raise, and you have choices to go to. The question is, where is all that? And that is going to be a bit of a problem. There is a company out there right now called CrowdTide, and what they're doing, they're providing a landing point for everybody to go to so they can start, navigating where the portals are. So it's at least that's a starting point. But I do get it. It'll be a lot for issuers, but most important, the one thing that I want you to take out of here, you have choices regarding your offering. Mark discussed it in detail, giving you, family and friends, angel groups. You can do deals side by side, a RegCF with a Reg D. And then, of course, making sure you disclose fully to your partners, what is the total round of capital you need? I know sometimes as entrepreneurs, you're going, I don't want to tell them everything I need because they may not want to talk to me. But the more they know, in particular your lawyer, the better it is, because there is a structure issue that you need to deal with, that you need to make sure you plan ahead. So, if your total capital intake for your business to be successful, regardless if it's, 5, 10, 15, 75 million, there are things that need to be structured in the beginning that is going to help you get there in the most efficient way, because otherwise you're going to need to unravel it. You know what I mean? So it's important that you do that with people like Mark Roderick, and Mark will bring in the best source for you to do your capital raise. You need a crowd. Okay, let's go to funding portal. I don't want a crowd. Okay, you go to that BD. I want a hybrid. Oh, that's interesting. Do you see what I mean? So this is where the choice selection for the companies is going to get better. So, John, you guys have been both sides. So you have had that advantage where some of the funding portals were strictly funding portals. Only as of late, they're becoming registered FINRA broker-dealers. How did you guys always take that? When a company came in through Flash funders, you would normally take them to the BD side, but now are you gonna put it all under the Flash umbrella and operate it there?
Well, no, it just depends what the company needs. Every issue is going to be different. Maybe a crowdfunding round is right for them. If they're like a niche market or niche vertical, a retail investor might not necessarily make sense of the product and their company and what they're trying to do. And you might just need an institutional or a set of accredited investors to come in and complete the round. It just depends on each issuer. It's a little bit different. One type of raise might be right for the other. But the CF isn't for everybody, and now there's Reg D. So it really just depends, and through conversations with them, we kind of determine and help guide them down the path of what might be the best suitable capital raise.
Yeah, let me just say by way of comment, I mean, that I wanted to say at some point here. As I say, I've been doing this for a long, long time, meaning helping companies raise money. And there is, ever since I've been alive, the place where people raised money, the cool neighborhood was Rule 506. Not so much 506 including non-accredited investors, but 506 accredited investor only raises under 506. That used to be the only thing we had, and since the Jobs Act, now we call it 506C. But Rule 506 is where all the money for small businesses gets raised in this country. The IPO market, yes, those are big public companies, but that market pales in comparison to the capital raised for private companies, and it's always been raised under Rule 506. In my opinion, these changes to Title III is going to change that landscape. Up until now, Title III has been a bad neighborhood, relatively speaking, on the wrong side of the railroad tracks. These rules are going to immediately put Title III on the good side of the railroad tracks. It is going to become the best neighborhood. It's going to surpass Rule 506. It is going to be where almost all the capital for private companies is raised. This is just, this is not the kind of thing to make you popular at a cocktail party, but in the world of raising capital, this is an enormous change that we're about to see. We're just going to see, billions and billions of dollars start to pass through funding portals. So, I mean, this is the time, for John's company and all the others. This is the time to be in that industry because it is about to become, that great retail neighborhood where there's people walking down the street all the time, looking in the windows, looking to spend money. It is just, we're about to see it explode. I am 100% sure of that.
I agree 100%. It is important to note that this significance, when we got the gift on November the 2nd by Commissioner Clayton, the timing was unbelievable. It came earlier than we expected, and here it is. Why? Because during the most horrific time in history, Americans stepped up. They came to the plate to help their fellow American with their companies. Online investing was on the rise. Some people are talking about 280%, 350%, depending where. The important thing is nobody gave up. People keep more forward. And as Mark alluded to, this year is going to be even greater. And I'll leave everyone with this. 1,100 companies raised capital in RegCF in 2020. $240 million was raised from 358,000 investors. This is just scratching the surface of where this is heading. So now this is the time where we usually give our audience an opportunity to ask questions. Simply click the button, raise hand, and we got Mark, leading regulation CF lawyer here that you can ask a question. Attorney, and of course, John Kong from Flash Funders, one of the registered funding portals from Sutter Securities. So when I say that, I'll bring you in, but in the meantime, we'll continue the conversation. John, you were about to say something and I cut you off there. Please continue.
Oh, apologize. I can't recall where I was going.
We were talking about, obviously the significance of this regulation is we're gonna see, as Mark alluded to, that it's going to change from the traditionally 506c was the route. Now, obviously with RegCF, companies are gonna pivot. I saw something that I never thought I would ever see, and Mark and I know this company very well, RealtyMogul, right?
Mm-hmm.
I know, and this company has been an advocate of accredited investor only. Remember that? Accredited only, no retail. Well, now they're doing crowdfunding. It just goes to show you that even the most advocates for dealing only with accredited, they're pivoting towards regulation CF and regulation A+, because they're seeing that it's working. And not only that, investors like it. Investors truly like this regulation better. Even accredited investors love regulation A better than Reg D because of all the other elements. And there's one area that we're going to talk the last 10 minutes here of our discussion, is that one of the options for regulation CF is the instant, you can incentivize the investor. So Mark, I'm going to put it on to you first, and then I'll go to Mark, but let's talk about incentivization, because you're the lawyer, you're helping. I want to give away what. So first of all, what are the limitations, and what are you guiding people with when they want to do it?
Well, first I got to say your news about RealtyMogul is very interesting to me, because I have written, I wrote a blog post. Well, that must be why they did it. I wrote a blog post as to why every Title II portal should become a Title III portal. So, I'm sure they listen to me, but I have actually written to the other two premier real estate Title II sites, CrowdStreet and RealCrowd, and implored both of them to create Title III sites. And I think they will. But anyway, so that's very interesting news, which I always get from you, Oscar, somehow. You are plugged in. So the question you're asking me is about limitations? Is that what you're asking me?
No, not limits. Obviously, we can incentivize investors when they're investing, right? We can give them a T-shirt, we can give them drinks, we can give them a toy.
Yeah.
So obviously, this is now becoming something very different. On the Reg D model, you can't incentivize them other than with the equity itself by giving warrants and all that. Nothing's stopping you from doing that as well here, but perks have become an integral element of RegCF, right?
They have, and I mean, you are allowed to offer perks in Reg D offerings. It's just a culture shift. It's not a legal shift. So,
interesting.
This is how. For the first time ever, I told Oscar something he didn't know already. So that is a first. But anyway, so it's a culture thing, right? So we started off, the very first thing I said, whether you had asked me or not, is to differentiate Title III from Kickstarter, right? I said, it's a different. But now here we are toward the end of our conversation talking about perks. Well, where did the idea of perks come from? It came from Kickstarter. So that concept that you should get something, some goodie, some non-financial goodie as a result of your investment, that is fertilization from the Kickstarter world over to the equity crowdfunding world. And it's sort of, it really is a cultural thing. Like, up until these days, raising capital was something only very serious white men in suits did, right? And you couldn't laugh about anything, couldn't smile. Of course, I'm being over the top, but you get the point. It was a very capital S serious undertaking to raise capital. Kickstarter's not. You know, Kickstarter's full of fun, cute videos, helping people, creating community. And so what we're seeing with these perks is kind of a cultural phenomenon where now raising capital is not just for very serious white men. You know, it's about more than that. It's about investing in things you believe in. It's about making money, but it's about doing good for a lot of people. There's a real cultural dynamic going on here that is about more than just legal rules, in my opinion.
That's interesting. So, okay, and I never thought of it, bringing it back to the point of that was the Kickstarter rewarding it. So, John, I mean, I'll go back to you. How do you feel with the perks? And now I got it. You can also use it for Reg D, but it's a generational thing. But I'd love to hear your comments on this.
Yeah, with the perks, it's absolutely a benefit. That's what kind of retail investors are somewhat familiar with coming over from the Kickstarter Indiegogo world. So that definitely provides some incentive for investors. But at the end of the day, I'm always an advocate of we just have to have good companies, good founders, strong executive teams, and whether the perks are there or not, I think they can raise capital. I'm not a major advocate for companies that approach us and advise them in introducing perks into their deal, although that can help. What I'm hoping for is that with the new rules, we're getting a different, color of companies coming through.
Yeah, and you are right. I mean, I think it's important. You don't need it, but we obviously see a lot of it. I mean,
Right.
in our previous webinar we had, we're way beyond the T-shirt idea. So make sure that you listen to that part as well, because I don't want to mislead anyone that just give away a T-shirt and people are going to invest. No, we're way beyond that part. So. But what I will say is that we're embarking on an area that we need to keep educating people. And what is important about a perk that sometimes gets overlooked, that there is a legality to it. And I've been doing this more often now in webinars, closing off with it, because there is a bit of a snag with it that people have not overlooked. So, and that is that when you promise anything, so when you promise an investment, people get it, they get their documentation, they're with their transfer agent, and everything is moving nicely. The perk is different. The perk is something that is not part of the security, but you made it part of the contract. And let's say it's a one-time perk. It's, you deliver it, it's all done. But let's say you're one of those that is providing a perk, incentivizing them to invest more, you'll do it more frequently, like monthly, quarterly, or whatever else. And we have run into a situation that if your perk is not properly structured, the investor can actually, if they make the investment using their credit card, they have 1 year from the date they made the investment to do a refund. And this is something that obviously no funding portal wants to have, because they wouldn't, it's coming after the fact. It's and it's a new component that the credit card companies have done, which goes outside the securities law element, which means how do you protect both sides, the investor and the company, and making sure that both separated. But the investor, being a retail investor, is saying, hey, I never got my product. Credit card company goes, okay, it's automatically put on reverse, and then you got to go back and prove the fact that you've delivered it. But it is something new. On that scenario, Mark, I mean, it's probably something you've not seen before. We have seen it now. It's a fairly significant amount of money, and the credit cards have fought back. And it's important, because if you're going to take this process and use these options, you need to plan all this out with your legal counsel as you're planning the journey, your capital raising, the terms and condition, and what you're going to provide. It's just as important to plan this out. Just like to hear your final comments on that, Mark, before we close off.
You mean with respect to using credit cards to fund these deals?
No, not. I mean, that's not really up to the company. It's really the funding portal. But the issuer, the company that is going to provide this opportunity to everyone, is doing something really interesting. It's offering a perk, right? And a perk, again, nobody has really done anything other than it's something that I'm going to provide you to incentivize you. Is that perk included in the subscription agreement? That's number one. Number two, what can we do to make sure to protect? We want to protect the investor to get what they were promised, but at the same time, keeping in mind that investor now has 1 year to do a refund on that investment, even though legally on the securities law, it's a certain point, but they can call their credit card provider and they can claim, I didn't get my product. And it's usually the perk, not the security, but the credit card company doesn't distinguish either or. Does that help you?
Well, I mean, I would certainly never recommend to an issuer that they promise to give investors their money back for the next 12 months. That to my mind would be, I mean, that's not good for anybody. I don't think, because if I give it to you, I mean, do I give it to all my investors, that everyone in this whole offering gets the right to get their money back? If I would never invest in that company, because what if everyone else wants their money back? Now the company's bankrupt and my investment's not worth anything. So that would be a terrible idea.
Yeah, no, I'm not suggesting that either. What I am suggesting, what I'm bringing up, is that if a company is going to incentivize investors, which is entitled to do, and let's say you promise to give, if somebody invested $100, you intend to deliver a case of juices, 6 of them, or vitamins, 1 jar. That's fine. But let's say if they invest $500, you're going to give it to them for 6 months. Okay. So what I'm saying to you is the following. When the investor made the investment initially on the funding portal and paid using their credit card, ACH, they have 60 days, but credit card has now, the credit card companies have extended online investing to 1 year. This is the new thing we're dealing with. That's why I'm bringing it to you, because I know you deal with this. So you're right. We don't want the companies to give it back, but we now need to take legal steps to make sure that companies who are going to offer the perks, because I get company, oh yeah, Oscar, I'm going to get these perks away. And I go, great. Have you spoken to your lawyer? Well, no, I mean, he doesn't have to do with the perk. No, you got to talk to your lawyer, because you got to make sure you can deliver this. Because when you go to the funding portal or wherever you're going to raise your money from, if you don't deliver those perks, those people can claim their money back. We now know that. The credit card companies have put the industry on notice that they're taking it up to 1 year now. This took into effect about September of 2020. So because they've seen the complaints, and now so traditionally a refund on a credit card was like 30, 60 days. Now it's 12 months.
Well, let me ask you this, because I don't know the answer, and I'll ask John. John, do you accept credit cards on your portal?
We do. We do, but we do kind of
have any trouble with it?
Oh, no trouble, but none of our issues are, giving out perks. I mean, I think that comes down to
it's not a perk issue, I think. I mean, I'm not so concerned about the perk. The one legal thing about perks is that they can get out of hand legally. A perk has to be, the value of a perk has to be insignificant relative to the price of the security. I've had issuers who have said, we want to offer this, for $500, you get $600 of merchandise, and I don't believe you can do that, because now your disclosure document is false in terms of what the price of the security is. But putting that to the side, let's say someone invested $500 and they got $25 worth of of goods. And I think the question you're raising, Oscar, is, well, 10 months down the road, you haven't delivered the goods, and now the investor can revoke the entire investment under the terms of its credit card, and probably legally too, under the terms of the subscription agreement. I think that's a risk. I think that is just a risk factor.
It is, and that's why I bring it up. I only bring it up on like a lot of things we're learning, we're evolving. David, as I said before, we're in a momentum, so we're evolving, which means now we, like everybody else, everybody's fixing their back offices. There was a moment, I know John knows about this, is that we had a disconnect where the credit card companies were disconnecting some of the online investment. So I'm just letting you know, I bring this as a discussion because we are stepping it up to $5 million, and the incentivization things that people are going to consider are going to be great. And we just need to make them aware. Okay, great. Listen, what is your delivery mechanism to make sure it's going to get done? Because we need you to understand the mechanics if it doesn't get done. Because that investor.
Yeah, I mean, if you were a portal in that situation, you might even say it's fine. You can offer all the perks you want, subject to the kind of Mark Roderick rule I just said about the relationship to the value of the security. But you know what? You're going to fund it up front. We're going to make you, if the total value, if you're raising $750,000 and the value of the perks you've promised is $50,000, you're going to take that out of the raise up front, and you're going to put it somewhere.
Mark, that's a very interesting point. Something interesting as well. Sorry, I'm going through my notes on perks. Something new that the SEC is requiring companies that are offering perks to put in brackets the value. That's a very interesting point you just said. That's a
well, there you go. I come through again.
Yeah, you come
yeah.
through.
No, this is a thing that it's because RegCF offerings are not policed by the SEC, right? There's no pre-offering filing, but the same issue comes up in Regulation A offerings, and there the SEC is reviewing the SEC, not the SEC, is reviewing the offering before you can start selling securities. And if you were, you're saying, well, the price of security is $10 per share, but I'm giving you $7 worth of product to buy it, well, then that disclosure is misleading because the price is really $3 a share. So it is a relevant disclosure item to ensure that the disclosures in your Form C are accurate.
Yeah, it's John, did you have some closing remarks on that point?
No, I mean, so our platform does accept credit cards, but it's one of those things where indeed the risks outweigh the rewards. When we hear a lot of Reg A Plus offerings where 50% of the funds coming in are coming in via credit card, debit cards, are we losing out on potential investors by not taking on that undue risk of allowing credit card payments to purchase stock? So that each one of those is a discussion we have with our issuers. Like, it's a risk you want to take on.
Yeah, and everything's about removing risk.
In some ways, I wouldn't, off the top of my head, I wouldn't mind somebody, the SEC or FINRA, saying you can't use credit cards to buy securities. That wouldn't. I think that wouldn't bother me. Nobody, I think everyone in our industry should agree, would agree. No one should be borrowing money at 18% per year to invest in a security, right? I mean, that's just
I would agree with you.
Thing.
And until I saw it happen, I didn't think it'd be allowed.
So the only good reason to buy with a credit card is I want the points. I want the mileage. But to my mind, allowing investors to get airline points is not worth the downside to all concerned. To an investor who might actually be borrowing at 18 or 24% to buy a stock in a speculative company, and it's not worth it to the issuer who's and to all the other investors whose investment is now put at some higher degree of risk because of the possibility that the company will have to disgorge money. So there you go. That's a rule we should all be in favor of.
Well, great, gentlemen. Wow, if that was it, we could have. I love discussions like this where it's just, again, we're discussing things that people often run into, and we got to deal with it head on so we can all discuss it and come up with solutions. So it's a win-win for the investor, win-win for the company, the funding portal, everyone involved. So John, always great to have you. It's great to see you again. Mark, loving the fact that we're connecting next time you have your camera on. Thank you for everyone who attended today. All these webinars are available to you at KoreSummit.io. We welcome you to come back and see us again. We're on tomorrow again at 11:30 a.m. and on 3:30 p.m. So thank you so much for coming out this afternoon. Have a wonderful week, everyone. We'll talk to you soon. Bye-bye.
Thank you very much.
You're welcome.